assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask a question. You may press star then 1 on your touchtone phone. To withdraw your question, please press star then 2. Please note, today's 60-minute call is being recorded. I would now like to turn the conference over to Charles Lambert. Please go ahead.
Thank you. Good morning. Welcome to the Medical Properties Trust conference call to discuss our second quarter 2024 financial results. With me today are Edward K. Aldag Jr., Chairman, President, and Chief Executive Officer of the company, Stephen Hamner, Executive Vice President and Chief Financial Officer, Kevin Hanna, Senior Vice President, Controller, and Chief Accounting Officer, and Rosa Hooper, Senior Vice President of Operations and Secretary. Our press release was distributed this morning and furnished on Form 8-K with the Securities and Exchange Commission. If you did not receive a copy, it is available on our website at medicalpropertiestrust.com in the Investor Relations section. Additionally, we're hosting a live webcast of today's call, which you can access in that same section. During the course of this call, we will make projections and certain other statements that may be considered forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. These forward-looking statements are subject to known and unknown risks, uncertainties, and other factors that may cause our financial results and future events to differ materially from those expressed in or underlying such forward-looking statements. We refer you to the company's reports filed with the Securities and Exchange Commission for discussion of the factors that could cause the company's actual results or future events to differ materially from those expressed in this call. The information being provided today is as of this date only, and except as required by the federal securities laws, the company does not undertake a duty to update any such information. In addition, during the course of the conference call, we will describe certain non-GAAP financial measures which should be considered in addition to, and not in lieu of, comparable GAAP financial measures. Please note that in our press release, Medical Properties Trust has reconciled all non-GAAP financial measures to the most directly comparable GAAP measures in accordance with Reg G requirements. You can also refer to our website at medicalpropertiestrust.com for the most directly comparable financial measures and related reconciliations. I will now turn the call over to our Chief Executive Officer, Ed Aldag.
Thank you, Charles, and thanks to all of you for joining us this morning on our second quarter 2024 earnings call. I'm pleased to be joined again today by Steve Hamner, Kevin Hanna, and Rosa Hooper. Also joining the call for Q&A this morning is Jason Fry. Jason has been with the MPT for 15 years and was recently named Managing Director of Asset Management and Underwriting. During the quarter, we continued to see positive trends across our global portfolio of hospital real estate. Consistent with what's been reported by large public operators, admissions and surgical volumes are increasing year over year, and the overall financial health of our hospitals is improving. Before Rosa discusses these portfolio trends in more detail, I would like to spend a few minutes providing an update on our capital allocation strategy, as well as Steward Healthcare's ongoing Chapter 11 restructuring process. Beginning with our strategy, we indicated last quarter that we were on track to exceed our initial $2 billion target for additional liquidity in 2024. We have successfully carried the momentum forward, executing several additional transactions at attractive valuations, including the July sale of freestanding emergency department facilities, as well as one general acute care hospital in Arizona to Dignity Health for approximately $160 million, or an implied cap rate of less than 7.5%. As a result, we have generated $2.5 billion in total liquidity to date and repaid all debt scheduled to mature in 2024. We remain focused on accelerating debt paydown and have several available levers to create additional liquidity, comfortably satisfying our expected maturities in 2025 and beyond. Turning to Steward, This is understandably a complicated restructuring process involving several interested stakeholders with competing priorities. The Massachusetts market has received the most public attention to date, which is particularly unfortunate as the noise in Massachusetts has slowed down sales process in other important markets where transitioning Steward's ownership is expected to be more straightforward. As a reminder, the 8 properties that Steward operates in Massachusetts are 50% owned by MPT through our interest in a joint venture with Macquarie Infrastructure Partners. These properties are also subject to a master lease agreement that's separate from all other Steward properties around the country. Since early 2024, well before Steward's Chapter 11 filing in May, we have sought to work collaboratively with Steward and the Commonwealth to keep its hospitals functioning and minimize patient disruption through the transitions to new operators, including stepping in to provide necessary capital when no other party was willing to do so. We have regularly met with the Department of Health and Human Services. We have participated in several rounds of negotiations with state officials to discuss viable solutions. We believe all of these hospitals are critical to the health care of the respective communities. And over the years, we have invested approximately $140 million over and above our original purchase price into these 8 facilities to fund various infrastructure upgrades. We have long maintained these facilities can be run profitably by other operators, and the recent bidding process validated this belief. Quality operators, including some of the largest private hospital systems in the country, showed early interest in submitting or actually submitted bids, contemplated various rent concession scenarios that MPT and Macquarie were willing to grant. In short, we believe there were several viable paths to keeping all 8 of these hospitals open, and MPT was willing to be a part of the solution to avoid closure of any of the hospitals.
So it seems like it's mostly a PR thing with the Massachusetts hospitals. Also, I paused the webcast because I got a notification that some ads were showing up and wanted to give people a few seconds to skip those before continuing. So,
unfortunately, the considerable volume of inaccurate negative commentary scared away or discouraged many for-profit and out-of-state operators from participating in the process. The Commonwealth's focus seems to have been on transferring ownership of these hospitals only to in-state, not-for-profit operators, and ultimately, the regulators determine who receives the license to operate these facilities. We are deeply concerned that the recent criticism of privately owned healthcare businesses and real estate owned by REITs stems from a misunderstanding that will only damage access to care and employment opportunities for healthcare workers over the long term. The fact of the matter is, every dollar of a hospital's own resources that is used for real estate is a dollar that is unavailable to invest in valuable patient-facing categories. And sale-leasebacks have proven over the long term to be a relatively inexpensive financing alternative compared to the other choices. Given the conditions currently being imposed on the sales process in Massachusetts, we believe exiting these 8 properties and allowing Steward and the Commonwealth to determine the most appropriate outcome is in the best interest of all stakeholders. Our primary objectives have always been to ensure that the health care of these communities benefits from our business model and to protect the best interests of our shareholders. We are obviously disappointed with the outcome in Massachusetts, but subject to court approval, we expect positive results in Steward's remaining markets based on the real estate agreements we have negotiated with new operators as well as others that are close to being finalized. We urge all parties in the process to move with a greater sense of urgency for the sake of all of the local communities. I'll now turn it over to Rosa to discuss the performance trends across our portfolio.
Thank you, Ed. As usual, I will take you through some of the highlights across our diverse portfolio of critical hospital real estate, beginning with a few high-level comments. As Ed mentioned, operators across our portfolio are reporting positive volume and EBITDARM coverage trends. General acute and behavioral health facilities, which represent approximately 75% of our total assets, reported particularly notable improvements. The post-acute segment, which includes our inpatient rehabilitation and LTAC portfolios, remained flat. In the UK and continental Europe, we continue to benefit from increased demand for private hospitals, an unmistakable trend over the past few years. For example, the Private Healthcare Information Network in the UK recently reported a 7% year-over-year increase in incidence of patients choosing private treatment options in 2023. And the head of the NHS is reportedly urging the UK administration to allow for more collaboration with the private sector in order to alleviate NHS backlogs. Circle Health, which was recently recognized by Health Investors as Private Hospital Group of the Year for the fourth consecutive year, is clearly well-positioned to capitalize on this trend and continues to deliver steady financial performance. During the second quarter, we announced the successful completion of approximately $800 million of new, non-recourse, non-amortizing secured financing backed by some of our UK assets operated by Circle, further demonstrating the tremendous value embedded in our UK portfolio. Also in the UK, Priory, which is the largest independent mental health care provider in the country and which consistently delivers more than 2 times coverage, continues to take action to innovate in this space and position itself to most efficiently service the heightened demand it continues to see. To that end, they are in the second year of implementing the Priory Plan, a comprehensive strategy for quality improvement through focusing on best-in-class services and measured outcomes. In Germany, Priory's parent company, Median, is delivering steady performance, making incremental improvements through both increased occupancy and higher reimbursement rates. Turning to our U.S. portfolio, excluding Steward and Prospect, general acute revenue trends remain strong, benefiting from higher admissions, acuity mix, and reimbursement rates. During the quarter, we closed on our previously announced formation of a new JV with a leading institutional asset manager to hold our 5 Utah properties operated by Common Spirit. This portfolio, in which we retain a 25% interest, is performing well, with admissions up more than 20% year over year. Ernest Health's consolidated EBITDARM coverage remains stable and above 2 times, with its same-store IRFs delivering strong performance, partially offset by the LTACs and new IRF developments. In March, Ernest successfully opened its first inpatient rehab unit inside one of their LTACs and is already seeing positive results from the unit. This was also the second consecutive quarter in which Ernest's new IRF development portfolio reported positive EBITDARM as admissions and revenues continue to ramp. Our LifePoint Health portfolio of hospitals was a big standout this quarter, recording its highest total admissions in nearly 3 years. As a result, LifePoint has realized material EBITDARM improvement over the last several months. In fact, LifePoint's EBITDARM results in May of 2024 were its highest in more than 2 years.
Okay, they're talking about the stabilized portfolio. I'm going to catch the people up that are just coming real quick. So the thing that people aren't liking is the press release, and they summarized it at the beginning of the call. You can see it on the investor relations page. They cut or have to cap the cash component of the dividend to 8 cents per share. Earlier in the year, they teased about a stock dividend, which means they could switch to something like a mix of cash and stock to keep the yield on paper the same, possibly to keep pressure on short sellers and that kind of thing. But they haven't gotten to that part yet. They're still kind of in the preamble part where they summarize what was in the press release, talk about Massachusetts and all that. And then now they're talking about the stable portfolio where everything's hunky-dory. And then next we'll probably hear about the things we actually care about and the analyst questions. So let's continue.
LifePoint Behavioral's operating performance also benefited from steadily increasing inpatient volumes as well as continued decreases in physician-related costs. Our Prime facilities saw 3% growth in admissions year over year. This quarter, we also announced that we completed the sale to Prime of 5 hospitals in California and New Jersey for aggregate consideration of $350 million. This consideration consists of $250 million paid in cash and a $100 million interest-bearing mortgage. Coverage at Scion Health's general acute facilities increased to almost 1 time year over year, driven by double-digit volume increases and substantial reductions in contract labor. Finally, Prospect's California facilities are seeing some positive momentum on the admission side so far this year, with an approximate 2% increase year over year on a trailing 12-month basis. This momentum has helped California coverages rebound from last year's cyber attack. Prospect fully paid its $18 million of cash rent due from the first and second quarters, as well as $4 million of cash interest. In summary, MPT has a well-diversified portfolio with more than 50 unique tenants operating across care settings. We are confident the steadily improving volume and cost trends we are seeing will continue to drive solid financial performance for the vast majority of the operators in our portfolio, and in turn, generate meaningful cash flows for MPT over the long term. Kevin?
Thank you, Rosa.